Good morning. Sorry for the slight delay there. Welcome and thanks for joining us for this portfolio update on the Amati AIM VCT. I'm Colin Thompson, one of the sales team at Amati. And updating you today, we have Paul Jordan, David Stevenson, and Gareth Blades. Just to give a few comments on the structure of the presentation, Paul will cover the broader stock market environment over the past year, particularly AIM and the current market backdrop, before focusing on the portfolio itself. The team will share the exciting new qualifying investments made in the last year and give some comments on those and what we expect from them. Before looking at the themes that we believe will drive the performance over the longer term, and we'll give some granularity by way of stock examples. Finally, we'll cover the stocks that have contributed both positively and negatively to performance over the past year. Importantly, this is an opportunity for you to put questions to the managers. So please submit them through the webinar page and we'll cover them off at the end of the presentation. With that, I'll hand over to Paul.
Thanks very much, Colin. And thanks for bearing with us through the technical glitch at the start. Apologies about that. So I thought it'd be worth starting with this long-term graph of the VCT since 2010, and really to give the context and just talk a little bit about how the product works and what it's for. I always start talking about the VCT by saying that this is a product that has a very specific purpose. The investors in the VCT have very generous tax reliefs, and the quid pro quo is that we put that money to work, that put investors' money to work by seeking out what we think are very promising growth companies and investing the money directly in them. So the VCT doesn't buy shares on the stock market, it's actually investing directly into companies in primary deals. And then it's an AIM VCT, so the idea is that the vast majority of companies that we invest in are quoted on AIM, and that obviously makes the valuation very transparent. So we're not trying to determine the value of most of these holdings, it's determined by the market. And therefore, not all VCTs are like this, but our AIM VCT is very much a stock market based investment. And it's designed to be a long-term investment as well. And the kind of companies that we are tasked really to look for are those which we believe can, if you like, power the future growth of the economy. And that's really why the government gives the tax reliefs for venture capital trusts and EIS investments. There's a very good data to back this up, and there's a strong conviction both inside government and in the investment community generally that the economy is in these times of very high innovation and rapid rate of change is dependent on the next generation of companies that come along, and Britain's future success will be largely formed by the companies that we're making now. So it's very exciting to be involved in running this product. It's very we have to think hard about the future and what it might bring. And the focus of the investments are therefore very much about growth. And interestingly, one of the new tests that was brought in for investments a few years ago is the growth test. So the money that we put into companies, we have to be able to demonstrate that it's going towards driving the growth of that business. You can see that the last decade has been a very fruitful period to invest in small companies. I think that's really reflecting the rapid rate of innovation, and in the digital world, it's been possible to start new businesses and make a very big impact with them. Nothing lasts forever, of course, and it's clear that the next 10 years is certainly going to be different to the last 10. There'll be different investment themes. There's the huge issue of environmental change and the requirement for environmental technology to assist in reducing our carbon emissions. That's going to be a big investment theme in this VCT and for investors generally over the next decade. And it's clear that it's no longer quite, the barriers to entry are higher for starting new digital businesses. And so as we examine the portfolio, you'll see that part of our philosophy that we've developed in running this VCT is that when we find a good business, we tend to stick with it for a very long period. And the AIM VCT is probably one of the longest term investors in the AIM market. And I think that that adds to its the impact it can make, if you like, both on the companies it invests in and also as a sort of beneficial presence in the market. Obviously, the last few months have been seen quite a downturn in the NAV, and we're going to talk about that and give some of the reasons. Clearly, some of it is to do with the general market sell-off, and it's when you have long-term investments in pretty high growth companies, the ratings of those companies can sometimes come into favor and sometimes fall out of favor. And we've been going through in the last couple of months a phase when the ratings have been coming back down to more normal levels. They were probably slightly elevated last year, and they've been normalizing, and we're going to show you that in some graphs. And we had a couple of more stock-specific incidents which brought down some share prices in some key holdings, and we're going to cover those too and explain that we remain very optimistic for both of those companies. One was Frontier Developments, and the other is Polarian, and we'll talk about both of those. This slide is always important. This just shows that we return capital to investors every year, which VCTs are almost unique in being able to do. And you should see the dividends in the VCT really as a capital return. We set the level of at 5%, and it's calculated on the year-end NAV that we calculated at the end of January. There is an interim dividend as well, which contributes to that. So you can see in the first half of 2022, there was a 4.5p dividend. The second half is still to come, so the full year will be a lot higher than 4.5p. And these dividends will go up and down with the NAV, but they'll be consistent, and that's the point about them. We recognise that investors very often use the VCTs as a sort of long-term savings vehicle, often for funding income in retirement and so on. And the dividends are tax-free, which is a huge benefit, and that's why I put a lot of emphasis on making them consistent, so that investors in the VCT can have some level of predictability about what they're going to be. We run the fund really as a team. We have a large investment team at Amati. These are my colleagues here: Anna McDonald, David Stevenson, Scott McKenzie, Gareth Blades. And we have sector specialties, as you can see. And when a company comes in for research, the person who will pick it up will be the person who has the most sector knowledge in that field. And so we can benefit from having that kind of sector focus between us. And so we run all the funds that we run, the UK Smaller Companies Fund and our AIM Portfolio Service, as a team, and place a lot of value on the extra dimensions that can bring. Now, this slide is one that will be familiar to anyone who's watched our presentations over time. We call it our bubble graph. On the bottom here, you can see the year of investment when the VCT made its initial investment, and on the left-hand side, the market capitalization. And what's really, I think, very striking about this graph to me is that had we done this 10 years ago and taken a snapshot 10 years ago, this would be dramatically different. And really, this graph, the fact that we've now got the scale going up to £2.5 billion, we have some pretty sizable, we have some investments in pretty sizable companies. And of course, the only way you can do that in a VCT is to buy them when they're small and hold them for a long time. And so that's something that we set a lot of store by, and that's really why we are long-term investors in what we do. The average holding period for our investments is now well over 7 years, and that reflects that philosophy. And you can see that there was a bit of a bumper crop of investments really in 2012-13. The market was pretty modestly rated then. The rules, I have to say, allowed us to do more things back then, and some of these companies that we invested in then probably wouldn't work under the new sets of rules that we follow, and that's something I'm always very upfront about investors. The rules, the way they changed in 2016, if you like, forces us to go a slightly earlier stage and have what I think of as a slightly longer run-in period with investments, where we're having to identify them a bit earlier and effectively take a bit more risk. So hence, I'm very pleased to say and pleased to see that a couple of the very large holdings in the fund, and they're large because they've been extremely successful already, are companies that we've invested in under the new rules. And I think many of these investments, that we've been making over the last few years have proven to be very profitable. And I think we've made a good accommodation to the way these new rules work. And we wholeheartedly support them as well. I think it's very good to focus the VCTs really down on this area of the economy where companies can struggle to raise capital and really benefit from the support they get from VCTs. Some of these holdings here I'm going to talk about in a bit more detail. Keywords, Learning Tech, Frontier, GB Group. They're pretty large companies. And what's been remarkable about them is the way that they generate long-term growth, and that's what I'm going to show you shortly. Just very quickly before doing that, the top 10 holdings here, you can get an idea for weightings. Keyword Studios, largest, Polarian, Sayat, or Ideagen. All the ones that have been here for a long time have got into the top 10 through making some pretty spectacular gains. And these were much smaller investments when we made them. The VCT itself was much smaller, as you can see by the total investment column here in the middle. So then just to cover this point about growth. So what we have here is a graph, and I apologize, it's very small on the screen and you may not be able to see all of the numbers. I'll try and get it a bit larger on my screen here so I can read out some of those numbers to you. Yeah, you can see on the black line is the share price indexed to 100 at the beginning, and the purple line and the gold lines here are the forecast EPS numbers for these companies. And what you want to see is that the EPS forecasts are gradually rising every year, and what you also want to see is that over a period of time you're getting enough growth in the EPS to justify a return. And what you can see in the case of GB Group, this is a very it's a global business now. It's a company that has become a leader at fraud prevention and online identity verification for online transactions. And it's with the growth in the e-commerce that we've seen over the last 10 years, the role that companies like GB Group play has become completely central to e-commerce, and it means that you know who you're dealing with, and they help prevent fraud. And so they've had very steady and strong growth over this 5-year period, and you can see it by the gradually rising lines here, and you can see the shares when the black line's above the EPS numbers here, they've been re-rated upwards. And what you can see over the last couple of months, and given the sort of deterioration in stock market sentiment, this is not too surprising. It's pretty quickly derated back to the EPS line, where hopefully it should find some kind of support, because we're pretty confident that GB Group will carry on seeing this kind of consistent growth for a good number of years to come, and that's why we're long-term holders in it. A very different example down below, and the number on the right here is these numbers get to around 200. So you can see over this period the EPS numbers have broadly doubled, and that's given the consistency of the rises, that's a strong performance. What you can see in Frontier Developments, this company started a lot smaller. The fact that the gold line here is negative is a quirk of the Refinitiv system here, because the EPS was probably negative at the beginning, so it's multiplied all the numbers into a negative number. So ignore that. That should really be a positive number. And the purple line's a little bit more visible. You can see the shares here have gone up by 4.7 times over this period, but the 2-year earnings forecast has risen by 13 times. And if you like, that's I think highly indicative of the kind of value that this company's created over the last 5 years. So actually you hardly even see the scales. They're not very good here. You don't really see the downdraft, but you can see on this EPS number there've been quite big downgrades over the last few months. And Frontier Developments is a video games developer. It had a period of spectacular success. Over the last 6 months, it's made a couple of mistakes and had some launches that didn't go quite so well, but it's now a pretty diversified business. It's a much larger company than it was. It employs 500-600, maybe even more people now. It had massive expansion. It's got a long pipeline of new games under development, and in the life of a video games developer, it's not unreasonable to expect a few unpredictable negative surprises, but we still really feel that this company can and has got the ambition to generate a lot of value in the years to come. and so we fully intend to hold it for a good number of years. And this is not the kind of investment we can make a new investment in a company like this. And then just to go through a couple more of these, this is really just to cover the big long-term holdings and to kind of give a flavour of why we see ourselves as long-term investors in these companies. This is Learning Technologies Group, a major player in the e-learning space globally and in Western markets, and strong in America, strong in Europe. And here again, you can see the share price against the EPS growth. And you can see here again, very strong EPS growth over this time. Quite a lot of this earnings growth is acquisition-led. In the case of Learning Technologies, the market often feels a bit skeptical about that and often doesn't rate it so highly. And in the case of Learning Tech, you can see that the rating of the company has actually gone down over this period, and the sell-off has brought that down further below this sort of long-term number. But it's a company where we've got very good high level of confidence in the management team, and again think that this company can generate good growth for many years to come, and that's really what we have to be focused on. We can't control the ups and downs of the stock market and the way that the shares get rated, but what we're really trying to identify is which companies can generate value, because that's how we think we can generate value in this fund and over the long run. And all investments in the stock market need to be seen as long-term investments, because you will get a lot of short-term volatility to sentiment, as we're seeing at the moment. But where companies generate value, that gets recognized at some point. And then finally, Keywords, again, a pretty remarkable story. Similar in that this has been a highly acquisitive company, and it's bought very well over a long period of time. It's really become one of possibly the global leader in providing digital services to video games developers worldwide, and in particular localization. And where a video game developer in, say, in America, who develops a game for that local market, wants to sell it in China or Japan or Germany or whatever, you need experts in the local content to turn that game into one that will be recognizable and fun to play for local players in that market. And to do that, Keywords needs to be a global business, which it's become. And again, very strong earnings growth, and the shares have derated quite a bit in the last few months, but we see ongoing value creation here. Now, just a quick word on those of you who know us well would have noticed that we've had a slight change of tack in 2021, in that we started a policy of making some investments in companies before they float, and we did that really to because we felt that we could get a lot closer to companies and get a more significant position in them by getting to know a select group of companies prior to flotation. And in many cases, they actually need that kind of support to get to market. And getting to market is not simple, and it requires financial resources. But where we think actually being on the market is the right route for companies, supporting them to get there actually is a bit of a virtuous circle for the VCT, because it also widens the pool of investments that we have available on the market and hopefully helps the market more widely. Sayata was the first one of these we did, and you'll notice that all of these, and this is very deliberate, have a focus on the theme of environmental technologies, companies that are developing products and services which are going to be important in allowing the UK to and other countries around the world to reduce their carbon emissions and greenhouse gas emissions. So Sayata had developed a new design of electric motor. We'd seen a lot of companies investing in battery technologies, but we felt that actually the motor area was one that really justified a significant amount of work. And the importance of the Sayata motor, it's more energy, it has more torque density than the traditional type of electric motor. And to use a technical word, this is what's called an axial flux motor, whereas traditionally electric motors use radial flux. And it means that this motor has a completely different shape. And the force that's being applied to the shaft in the middle of this rotor is being applied at a much further away from the axle. And that clearly, you have to be have a PhD in mechanics to understand that you're going to get much better leverage on the axle. You get a much better torque in turning it by applying the pressure further away. And so the torque density of these motors is higher. They're reckoned to be 10% more efficient as well. So you'll get 10% more out of your battery life, but you'll have a fundamentally more powerful motor. And we felt actually this was a really important thing to bring to market. And it successfully floated actually about 3 months after we made our pre-IPO investment. We made a good return on the pre-IPO, but we've also made a good return on the investment we made at IPO. We did a follow-on investment in it. There's a couple of other companies here just made since then. One was in this company Alexis, which is an Australian-based business. What they're doing really, they've developed a product which addresses a very significant problem in connecting renewable energy generation to the very edge of the grid. And Australia has it's an incredible country for solar power, one of the best in the world, whereas unfortunately the UK is amongst the worst in the world for solar power. That's just nature, there's nothing we can do about that. But in Australia, solar power is extensively applied, but the problem is that the grid fails, and most of that solar power gets turned off, or a very big chunk of it does, by the grid, because if it turned it on, they'd have voltage spikes. So Alexis has a device to address that problem and form microgrids at the edge of the grid. And again, we thought this was going to be an important technology with many applications worldwide. So we wanted to support the company to get to market. We invested £2 million. Quite a lot of other investment went in alongside us, and we're hoping that this company can float towards the end of this year. And then Flylogics is a drone business. These don't look like the kind of drones you might have seen. These are actually winged aircraft, and they can fly 400 or 500 miles without a pilot inside, and they're flown remotely by a trained pilot. And the market that Flylogics has cultivated is for using these drones to fly to offshore oil and gas installations to do very, very accurate methane measurements to confirm exactly how much methane is emitted from those sources. And prior to making these kind of flights, you could only ever really use a kind of accounting estimate. But with the much increased emphasis on reducing these methane emissions, because they have methane is on a 100-year view, 33 times more greenhouse gas potent than carbon dioxide. So and on a shorter term view, because it degrades over time, but on a short term view more than that. So clearly this is a big area to address, and BP are getting close to the company, and they work with 5 or 6 of the major North Sea oil producers, and we're optimistic about how this company can be taken forwards. And again, this one hopefully will float later in the year. This is showing the amounts we invested. That was our return on the pre-IPO investment at float for Sayeta. And then just quickly jumping on here, this covers all of the investments we made last year, and showing our returns. These returns were to the end of December, so some of these will have come down since then in the market turmoil. I should say that the dotted lines here just show where we actually took some profit during the year in some of these holdings, and because shares had a particularly strong run. But nonetheless, we still see ourselves as long-term holders of these. Most of them have been pretty effective investments, as you can see on this graph. And please ask any questions about ones you'd like to know more about. And then we'll just move on to the themes. I've talked a bit about this environmental technology and services theme for the pre-IPO investments, and it was already a significant theme in the fund. And Aracor was an investment during the year. That's a company that David can talk more about later, but it's a company that specializes in installing ground source heat pumps and other equipment in the UK, and it's been a high growth business on that front. Water Intelligence is a company that does a leak detection in the States and has a UK business for more commercially focused for leak detection. Ilika is a battery technology company developing solid state batteries. GTech is developing a really interesting business in building hydrogen infrastructure around the UK, and it has the software and technology to identify the best sites. It has licenses over many of the best sites, and some of those are now going into development. Velocis has a technology for developing zero carbon jet fuel, and it's I think we should see some pretty major developments towards building their first plant in the US later this year. It will take 3 years to build it, but what we're waiting for is for them to reach financial close on the first plant, which then sets that all in motion. So Nova might just be worth mentioning. It's a tiny little company, but it has some very interesting set of products, some really innovative insulation products and insulating paints, which you can paint onto a ceiling or a wall, and provides insulation, but also the same product is turned into a render for rendering houses to put on the outside. And they also have a large range of pretty amazing fire prevention products. So highly innovative company. And that one we have an option to invest more money of it in that company, which if we want to go ahead, we'll exercise in the next couple of months. And with that, I'm going to hand over to Gareth to talk about the healthcare theme in the portfolio. This is a big chunk of the portfolio. Thanks, Gareth.
Thanks, Paul. So the healthcare holdings in the VCT represent the huge breadth of opportunities available in the sector. So these include AI applications such as intelligent ultrasound, medical devices with Creo, Angle, and Polarian, diagnostics with Verizon Dx, as well as tools and service providers with companies like Maxite, Aracor, Tristel, Diaceutics, and Aptima Group. And then there's also specialty pharma, and that includes companies like Amrit, Diurnal, Allergy Therapeutics, and Synergen. But what unites all the healthcare companies in the portfolio is really a truly unique technology or product offering, which can significantly impact on a large market. And I think the thing to remember about healthcare is that spending on healthcare happens through the cycle, so it can act as a diversifier. Ultimately, people always need better treatments, diagnostics, and medical devices. And as you can tell from the list, we have a greater exposure to lower risk subsectors such as diagnostics, tools, and service providers and medical devices. And these traditionally are areas where development is less risky and less expensive, while time to market is shorter than drug development. So, for example, Maxite is a life science tools company focused on the fast-growing cell and gene therapy market. It's developed the leading electroporation machine, which is used for manufacturing potentially life-saving treatments for hard-to-treat cancers and rare diseases. In 2021, the company had sales of $34 million, which was a 28% increase on 2020. And the longer-term potential for Maxite is built on exposure to milestones and royalties for drug development programs that would subsequently be approved and launched. And so in that regard, the next 2 years will be really pivotal for the company. Verizon Dx is another example. It's focused on diagnostics. It's developing a unique end-to-end or really diagnostic solution for kidney transplant patients and their doctors. And their tests assess the likelihood of kidney rejection before, just after, and in the longer term after kidney transplant. And with this information, doctors can then start to more sensitively manage patients' needs and tune their medicines more acutely to better or to enable a better standard of care. Verizon is awaiting pivotal clinical trial data after it ran a very successful trial actually during the pandemic. And should it be successful, Verizon would be very uniquely placed in a market that's dominated by older and generally poorly performing diagnostic tests. When we consider drug development, we do this carefully to identify opportunities that offer traditional drug sector upside while managing the downside risk. So an example of this would be in the reformulation of drugs. In these cases, the drugs are generally well known. They're normally approved, and they're just being reformulated or repurposed into a new indication. So there should be, and what we look for is a strong body of evidence to support good toxicity, safety, and efficacy. So Aracor, which I believe we invested in last year, is a good example of this. It specializes in unique and high-value reformulations of drugs. So customers include large pharma, leading biotechs, and generics companies. And Aracor uses a platform technology to intelligently select the right ingredients, essentially to match the reformulation requirements of customers. And Aracor is paid for this development work and generally negotiates downstream milestones and royalties on sales of successfully developed drugs. On top of this, Aracor is developing its own unique high-value reformulations of insulin to treat diabetes. Overall, we aim to avoid the highest risk parts of the sector, and in fact, our exposure to the riskiest part of healthcare, which is generally single asset drug development, is limited to Synergen. And I'm sure many of you will be familiar with the company, and it's developing a treatment for COVID-19. Synergen is due to announce results from its global phase 3, should be this quarter, which, if successful, would be a significant milestone for the company. And the portfolio spans the different stages of development risk, from the more speculative to the highly de-risked, such as Amrit and Tristel. Tristel is an infection prevention business. It's developed a proprietary chemistry, a biocidal chemistry, and the only one of its kind that can be handled manually, actually. And so this is applied to manual cleaning of medical devices and surfaces. And we first invested in 2005, and the company's been profitable since 2006 and has grown sales from around 3 million in 2005 up to 31 million in 2021. And Tristel still has growth left in it through an expansion into the US, which is expected in 2023. And then Amrit is probably the standout company in terms of specialty pharma. It's one that focuses on the development of medicines for rare diseases. Amrit has 3 launched drugs and is highly cash generative, delivering 3 upgrades on numbers last year. And a regulatory decision around a 4th drug is expected by the end of February from the FDA. And this treatment has the potential to achieve blockbuster status, which would mean it would reach $1 billion in sales. I guess it's appropriate to touch on Polarion here. It's worth mentioning that the company submitted its FDA application at the end of 2020 and was, by all accounts, engaging well with the FDA up until the run-up to what's called a PDUFA date, which is when the FDA finally gives you a decision on whether it's an approval or not. What they received was something called a complete response letter. This is essentially a list of questions that the FDA want answers to before they can progress any further with your application. I think what's important to mention about the CRL, about the complete response letter, is that it doesn't require any more clinical trials. It's more around technical aspects of the technology and manufacturability. The company is confident of being able to answer these questions and is going through the process of answering them before refiling. And I think it's also worth touching on that the company is fully funded for the next 2 years, so it should see it through the refining process, a decision, and hopefully commercial launch. The technology is one that is better than anything else on the market that's currently approved. It's very highly supported by KOLs, and it has no safety risk. So in terms of, and it's highly efficacious as well, that needs to be touched on. So in terms of a risk profile for a regulatory approval, it ticks a lot of boxes. I think what the FDA are experiencing at the moment, due to the surge in COVID-related approvals and requests for advice for medical devices, tests, and drugs, is an unprecedented level of demand, and this is impacting on their ability to progress applications in a timely manner. That's being talked about a lot in the industry at the moment. So although disappointing, it's perhaps not surprising that Polarion received a CRL so they could do their due diligence properly and hopefully head towards a regulatory approval later this year. And with that, I'll pass to David to talk about digital technologies.
Given the time left, I'll go through these next slides reasonably quickly. This grouping, which is a very broad church, contains some of the largest and most established businesses in the portfolio, and a number of these names you'll have seen feature already earlier in the top 10 within the portfolio. Collectively, they amount to 17% of portfolio value. Cloud Call, top right, has just been the subject of a private equity bid, so that has now exited the portfolio. Market cap ranges right up to 1.5 billion, and the largest of these companies are long-term profitable and dividend paying. GB Group that Paul's already mentioned has been in the portfolio for 10 years, so running these as winners, we've enjoyed that long-term growth dynamic. End markets covered are very diverse. These companies provide software and platform capability within leisure, cyber security, healthcare, compliance, e-learning, and casino gaming. So a very well diversified range of end markets. This theme arguably could include two of the names that Paul showed earlier, Frontier and Keywords, since they link into these technologies as well. In terms of geographic distribution, we're always keen to show this slide because it cuts through the idea that running a UK AIM VCT means that our exposure to underlying revenues will be predominantly UK. We do clearly have quite a substantial segment of UK revenues within our investee companies, but the reason we invest in smaller companies is we anticipate and hope that they will become international growth stories, and that is what drives the other segments of the pie chart here, and you can see very significant representation within the portfolio to wider geographies. This slide shows the sector weightings. According to the sector classification, our themes would cut across this. So, for example, the sort of stuff we're doing in environmental technology, new energy, would cut across a variety of these sector classifications. But the standout feature is the significant exposure we have to healthcare and IT, as the themes have already indicated. This is also reflective of a couple of things. Firstly, a significant proportion of our qualifying deal flow is in these two areas, in line with the current rules, which have changed over the years. So we have a remit to back companies, knowledge-intensive companies, in these two areas. And it's also representative of the fact that we are targeting companies with significant IP, which can provide entry barriers to competition. When you invest in smaller companies, the risk is always that there are bigger and better and more aggressive competitors out there, and having IP and some form of entry barrier protection, it gives time for these companies to get established and build up their market share. In terms of deal flow, you saw earlier how active we've been in 2021. Pleased to say that the opportunities being shown to us are now back at levels that we saw 5 or more years ago. We are still very selective in the participation. So in 2021, just 1 in 5 of the deals we looked at did we actually invest in. And the other point to note is the sort of change of mix in 2021 relative to 2020. 2020 was a year of significant activity in new companies to the portfolio, IPOs, fresh fundraisings. In 2021, we've done more in the way of follow-on deals. Sorry, round the other way. We have done more in the way of new companies in 2021 and less in the way of follow-on deals. That's different from 2020, which was much more about supporting companies through the difficult trading environment of the lockdown and the global pandemic. In terms of what's contributed to our performance, I think given the overall NAV, it's more important to focus on the negative slide, which comes next. In terms of positives over the last year, we've already discussed Saeta has a very strong IPO debut in the middle of last year. Water intelligence, Paul's already spoken about. Water intelligence is a franchise business model. It's seeing good organic growth in the areas that it specialises in, water leak detection and remediation. But they also, given the high rating of the shares as a result of their long-term growth achievements, they're able to do very significantly value-enhancing acquisition deals where they buy back in exiting franchisees. And that a combination of organic and that sort of acquisitive growth has driven the performance. I'll mention also our smaller companies fund at the bottom, which over the course of last year saw good absolute gains, albeit that it lagged its benchmark. But those absolute gains reflect a very strong environment for UK smaller companies during last year. Maxite and Angle have really already been covered by Gareth, so I'll pass on now to Paul.
Thanks, David. And then, yeah, just to cover off the fallers, Frontier Developments, I talked a little bit about earlier on. Ixico, it's a company Gareth talked a bit about. It's a data provider to companies that are running clinical trials for anything to do with the brain. So difficult to treat diseases like Alzheimer's trials the companies would bring an Ixico to monitor the data, and they do the image processing. So it's really an image processing specialist. They had one of their major customers trial fail during the year, and that was a bit of a setback. Although the company's been making very good progress in replacing that business, it's a setback for a period of time. We still like the company a good deal. Velocys has had some big ups and downs. It's fair to say its projects have taken longer to get to financial close than we originally envisaged, but we do now feel that that's very close to getting the first one done, hopefully by the end of the first quarter. GB Group, you saw the bit of a derating the company had when I had that slide earlier, and it's come back more to its sort of longer run levels. They raised money to fund a big acquisition of a company called Acuant, raised £300 million. And it was a slightly difficult acquisition to do because they bought it from private equity. They felt it had a lot of strategic value, but they paid a high price for it. So it left the shares a little bit lagging for a while. We think that if they can prove that actually that was a strategically very valuable business, which we think they can do, that this is going to pick up again. And then Polarian, Gareth's talked about. I should just add with Polarian that it's been very frustrating and difficult for investors across all healthcare that the FDA, the regulatory agency in the States, went into a sort of dysfunctional zone, really, where so many of the decisions that they needed to make just got pushed out, and giving companies a CRL was an easy way of doing that. Other companies have just had outright delays and been told that it's going to take longer. And really across the board, companies that have expected to get approvals in the second half of last year have not, and they've been delayed. So, we don't think it's anything specific to Polarian that they had that delay, but it's still deeply frustrating for investors and our co-investors in Polarian. But we definitely hope for better fortunes to come in 2022. And with that, I will finish there and turn it over to any questions.
Thanks very much for that, Paul, and to David and Gareth for their presentation there. We have a couple of questions. I'll add that anything on the upcoming offer we'll take up offline with you and get in contact, and we'll deal with the portfolio ones here. So you talked about last year's investments. Can you give an indication of what the future pipeline is like?
Yes, I mean, it's interesting that you'll have seen the pace of deals really picked up in 2021. It was a very busy year. That's reflecting strong markets, of course. And when the market's kind of flying as it was last year, naturally lots more companies want to float. And this year, there's still a lot of companies wanting to get to market. We think it's going to be more difficult, but we also think when the way that works with the VCT is that, on the one hand, when markets get difficult, yes, that's painful for the NAV, but it also gives us the opportunity to invest on better terms. in new companies. And we do have plenty of firepower already in the VCT. After this fundraising route, we'll be very well placed to make new investments, and we think that actually we'll be able to find the companies we like on better terms because of the tougher environment. But no doubt fewer will float. We've got one pre-IPO investment in train that's well on the way to being completed. That one's actually in a software company. So I think we'll invest in fewer companies this year, but there'll still be a very healthy pipeline, and hopefully we'll be able to invest on good terms.
Great, thank you, Paul. Paul, in your introduction, you stated that barriers to entry are higher now for new digital companies. Can you provide more colour as to why that is, and comment on how that is good for the portfolio?
Yes, I think it's like any new industry that in the 2010s, the application of digital technology to so many different industry segments had only really just begun. And we're now 10 years into that. And you could say that goes back to the year 2000, and of course it did, but the year 2000, 2010 was very turbulent, and everyone was full of ideas about what to do, and people rushed in, but there were lots of failures because the technology wasn't quite ready, and people weren't quite well enough connected to the internet to make these things work, and they weren't used to enough to deploying the technology. In 2010, that really reached a state of readiness, and lots of very small companies grew very fast. But I think if you try to do the same thing again now, it's everything's already much more crowded, and so the advantage swings back more to the companies that have already got there. And maybe a good example is something like Frontier Developments, which the video games developer, which when we invested in it was fundamentally, we were supporting it to fundamentally change its business model from being a company that just developed games for other people like Microsoft and Sony and Nintendo, to being a self-publisher. And the reason they could become a self-publisher was because the digital technology for distribution was there, and people were changing their habits to buy games online rather than going into shops, and that allowed them to go direct to market. If they were a company trying to make that transition now, find it just much more difficult because it's a much more crowded space. You need to now be very, very proficient at publishing. You need a lot of capital to make the change. You need a huge number of skill sets. And so, to be an incumbent now is important, and the barrier to entry just starts to rise. It's not to say that it's impossible. It's more difficult. And I think that's now the case for, many other similar applications of digital technology. It's a more crowded space, and it's more difficult to get a foot in the door if you're not already there.
Thank you, Paul. We have a further question. How quickly do you expect to invest the 10% cash? Who would like to take that?
David, why don't you go for that one?
Okay. We've had a strategy and a policy over many years to only raise sufficient cash that we felt we could deploy within the requirements of the legislation, the VCT legislation, and also reflective of the run rate of deals that we're being shown. And hopefully what comes across from today's presentation is that we are seeing a substantial pickup in deal opportunities. And out of that, we can see some very interesting companies. I think as well, our approach on pre-IPO deals, as Paul has mentioned earlier, secures us a significant seat at the table and allows us to deploy more funds at IPO, at the point at which these companies come to market, relative to us competing with several other VCTs to get a position at a later date. So both of those, a combination of those two things, I think deal flow and pre-IPO will see us utilize the cash.
Just one thing to add to that. I meant to say this earlier, but it's worth mentioning that we don't do pre-IPO investments lightly, and we run a very different investment process for private companies from public. I think one of the things we learned from the past is that you have public companies, a huge amount of work has been done, and you have a prospectus and a vast amount of due diligence. When we're investing in pre-IPO, we use different instruments to invest. We typically invest through convertible loans. We have to do legal due diligence and all kinds of other work on the company. We do charge the company fees for our investments, but all of those fees go on the costs that we have in making the investments, and sometimes a bit more than that. So it's a very different process. It's much slower. There won't be large numbers of pre-IPO investments, but we think it's valuable to have some that then hopefully go on to become situations where we own a significant chunk of the company, we help it float and become long-term holders.
Fantastic. Thanks very much for that, Paul. I think with only a few minutes to go, I think we'll wrap up there. There are one or two other questions there, which we'll get back to you on directly, particularly on the upcoming offer. As I mentioned, there is an upcoming offer. It will be live on the 16th of February at 10 a.m. And it will be, again, like the last time in the summer, which went really well, on online only application basis, on a first come, first serve basis. So thanks very much for your questions today. And if you have any others, you can contact us on either the investor line, which is shown there, and also on the website, and or alternatively contact one of the sales team, Rachel, myself, or John. So once again, thanks for your questions and thanks for your attention during the presentation, and thanks for joining us. And until the next time, goodbye for now.